Welcome to This Explainer. Today, we're completely tearing up the traditional hands-on real estate playbook and architecting something much, much more powerful. We're talking about the concept of triple net, or NNN, commercial leasing. Look, if you're tired of fielding angry tenant complaints or constantly paying to replace hot water heaters, this is absolutely for you. Triple net commercial leasing is a low-touch, highly predictable vehicle for passive wealth. Over the next few minutes, we're going to build a strategic roadmap for your capital. We'll show you exactly how institutional investors secure long-term inflation-protected equity literally without picking up a single hammer.
All right, let's dive right into this roadmap. Today we'll be covering the passive wealth roadmap, unpacking NNN lease types, evaluating tenant solvency, beating inflation with escalations, and finally the residual value safety net. Starting us off, Section 1, the passive wealth roadmap, shifting the paradigm. Now, to really grasp the power of triple net, we first have to understand the massive paradigm shift it represents compared to traditional real estate investing. Think about traditional multifamily real estate. It's a fantastic asset class, right? But let's be totally honest. It is a highly operational sprint. You're the one dealing with that plumbing disaster at 2 in the morning, you're mediating noise complaints between neighbors, and you're eating the constant, costly churn of short-term lease turnover. Now, contrast that with triple net leasing. This is a completely different game. It's a strategic, hands-off marathon. When you buy a high-quality NNN property, you aren't just buying bricks and mortar. You're fundamentally purchasing a long-term corporate contract. It's an institutional, fully hands-off alternative that frees up your absolute most valuable asset, which is your time. Moving right along to Section 2, unpacking NNN lease types, the contractual foundation. So in traditional real estate, the landlord collects what we call gross rent. And from that pile of money, you, the landlord, pay out a massive chunk for taxes, insurance, and upkeep. A true triple net lease completely flips that script. It passes all those heavy financial burdens directly down to the tenant. Now, the tenant does pay a slightly lower base rent, but they take on the financial responsibility for the three nets. But here's the thing, you have to read the fine print. There is a huge distinction between an absolute NNN lease and a modified NNN lease. An absolute NNN lease, that's the holy grail of hands-off investing. The tenant handles absolutely everything. Structural roof collapse, total foundation failure, that's on them. Even if a natural disaster literally wipes out the building, that corporate tenant keeps paying you rent while they manage the insurance rebuild themselves. On the flip side, we have the modified NNN lease, which is often called a roof and structure lease. Here the tenant covers taxes, insurance, and operating costs, sure, but you, the landlord, hold the liability for the structural integrity of the load-bearing walls and the roof. Knowing exactly what structural liabilities you're holding before signing the dotted line is absolutely critical.
Which brings us nicely to Section 3, evaluating tenant solvency, the financial engine.
Because your property's value relies entirely on a tenant's ability to just seamlessly pay rent for the next 15 to 20 years, you have to evaluate them exactly like a bank underwrites a loan. The gold standard here is the investment-grade tenant. We're talking about a massive corporate entity carrying a credit rating of BBB or higher from S&P, or Baa3 or higher from Moody's. Global behemoths, right? McDonald's, CVS, Walgreens, Dollar General, Walmart. The massive advantage here is that the global parent company legally guarantees your lease. I want you to think about that for a second. Even if your specific store location hits a rough patch and completely underperforms, the global corporate headquarters is still legally obligated to wire your rent check every single month. That is an incredibly powerful sleep-at-night layer of security.
However, you've got to watch out because not all recognizable brands operate under that corporate umbrella. While an investment-grade corporation provides that global parent guarantee, which gives you super high liquidity, albeit usually at compressed yields, regional franchisees operate very, very differently. You might buy a building leased to a famous fast food brand, but it's actually operated by a private group, say an 8-unit regional franchisee. Well, if that specific 8-unit operator mismanages their business and goes bankrupt, the corporate giant is not coming to rescue you. The rent simply stops entirely. You're basically trading the massive safety of a global corporate guarantee for the localized risk of a private operator, usually to chase slightly higher yields.
So, the crucial takeaway here is this. If you are going to take on the risk of a regional franchisee, you must mitigate it aggressively. You have to demand 3 non-negotiable documents before you ever close a deal. First up, you need their corporate balance sheet so you can see their true liquidity. Second, you need the operator's store-level financials to see how your specific location is actually performing in the real world. And third, and honestly perhaps most importantly, you need to calculate their rent-to-sales ratio.
Ideally, this must be under 6 to 8%. If it's creeping higher than that, the location is fundamentally financially stressed and your rent checks are at serious risk. Let's shift gears now to Section 4, beating inflation with escalations, the wealth fuel. Make no mistake, the single greatest threat to a 20-year flat lease is inflation. If your rent never changes over 2 entire decades, your purchasing power will just slowly erode into nothing. Institutional leases solve this by building a defense mechanism directly into the contract itself. We call these lease escalations or rent bumps. These contractual defense mechanisms generally fall into 3 buckets. First, fixed percentage escalations. These are super common. Think a 10% rent bump every 5 years or maybe a 2% bump annually. Second, flat dollar increases, where the rent goes up by a fixed monetary amount, like an extra dollar per square foot every 5 years. And third, we have CPI-linked escalations, where rent increases are tied directly to the consumer price index. So if inflation spikes, your rent spikes right along with it. Now, these often feature what we call a cap and collar, meaning there's a minimum 1% bump to protect you in flat years and a maximum 3% cap to protect the tenant in hyperinflationary periods. Basically, these structures act as an automatic, built-in inflation shield. Okay, let's actually look at how this math builds in the real world, because this is where it gets really fun. Let's assume a standard 10% rent bump every 5 years at a constant 6.0% market cap rate. In years 1 through 5, your annual base rent is $120,000. At a 6% cap rate, your capitalized property value is exactly $2 million. Now, the 5-year mark hits. Boom, the contractual rent bump kicks in. In years 6 through 10, your rent bumps 10% up to $132,000. Suddenly, the value of your property is mathematically forced up to $2.2 million. Then we hit year 11, another 10% bump. Your annual rent is now $145,200, and your capitalized property value shoots all the way up to $2,420,000. And that brings us to our magic number, $420,000. That is $420,000 in massive forced equity appreciation generated by year 11 through pure mathematical compounding. You didn't do a single renovation, you didn't pick up a hammer, you didn't field a single late-night tenant complaint about a leaky roof. The contractual architecture of the NNN lease automatically generated nearly $500,000 in wealth over a decade just by existing. How amazing is that? Finally, we arrive at Section 5, the residual value safety net, the PRI paradigm. Now, as great as all that sounds, it's time to pivot to a slightly more sobering reality. An NNN lease is an incredible contract, but at the end of a 15 or 20-year term, that contract expires. If the tenant decides not to renew, you are left holding an empty physical building. This brings us to what we call the PRI paradigm. Never, ever ignore the residual real estate value. You have to ensure you are buying a fundamentally great piece of dirt, not just blinding yourself with a glamorous corporate contract. If you own a highly specialized, oddly shaped single-purpose structure sitting in a dying, outdated retail corridor, it is going to be insanely expensive and difficult to release once that corporate tenant packs up and leaves. The underlying real estate must have intrinsic value on its own. As we wrap up this explainer, I want to leave you with this final vital question to really chew on. Are you currently building a portfolio of active headaches, or are you constructing an automated roadmap to true passive wealth? The strategies we explored today aren't just about real estate. They're really about architecting your capital to work relentlessly for you so you simply don't have to. Take a hard look at how your capital is deployed right now and ask yourself if it's truly serving your ultimate goals. Thanks so much for joining me today, and keep architecting that passive wealth.